All right, as we mentioned, that November jobs report showing a gain of 263,000 jobs last month. That was just the beginning of the strong numbers there. We have seen some significant moves across just about every asset class. Dow futures down by 311 points, NASDAQ down by 207, the S&P down by 48. Joining us right now for a technical look at the markets is Katie Stockton. She's founder and managing partner at Fairlead Strategies, also a CNBC contributor. And Katie, we could talk about equities in a moment, but let's talk about the 10-year because we watched the yield go from 3.51% just before that number to 3.62 just after. That is a significant move. It's a Friday. It's the end of the week. What's happening and how does this change things?
Yeah, actually, I mean, it's really definitely a notable move.
Now.
Okay, wow, yeah. So the support for the 10-year is around 3.5%. So it would be a very natural place for some kind of relief rally in yields following their corrective phase. And naturally, you could expect that that won't be well received by equities, of course. And, you know, we're at a point where the equity market is pretty stretched, as you know, especially after Wednesday's rally. And we have these counter-trend signals that are not showing up yet in yields. They're showing up elsewhere, and certainly in the equity market and then also in the volatility index. So there are some indications here that we might have an inflection.
What are those indications?
Yeah, specifically for the volatility index, which of course is inversely related to the S&P 500, there have been some signs of short-term downside exhaustion. We talked about those at the start of the week. They're based on the DeMark indicators primarily, and also the MACD indicator, which is a momentum reading. We've seen momentum shift favoring an increase in volatility, which would be a market negative. So now what we're watching on the S&P 500 index, for one, is to see if it has a corresponding loss of short-term upside momentum. Today could certainly be the start of it. It takes a day or two usually to impact the indicators because the indicators are designed to reduce any kind of noise. So we suspect that maybe next week we'll have these sell signals for the equity market, and we would be ready to get hedged with that in mind.
Wow. We're doing this on a weekend when we're heading into all kinds of crazy things that could be happening to impact the oil market, too. You've got that OPEC Plus meeting. You have the embargo that's set to take place on Monday, the question of whether there are going to be a price ceiling set for Russian oil. Right now, 81.25. I think I saw that WTI was up more than 6% this week as of yesterday. That's a pretty rapid move. What are the signals telling you here?
Well, it's really been very choppy in WTI crude oil, which really shows indecisiveness, in my opinion. But there is very good support on that chart between about 75, which is short-term support, and $70 per barrel, which is longer-term support. And this would be a natural place for stabilization, which is essentially what I think we're seeing, an initial reaction to the short-term oversold condition this week. So if anything, we think that probably within what we think is a long-term trading range, that the upward bias is there for crude oil, not just in the recent term, but also in the coming weeks. The resistance that we have on the chart initially is really in the mid-90s. So that obviously would mark another significant gain from here.
Dollar, I haven't seen what its latest trade has been post this jobs number, but yesterday it was off by more than 1%. It's been down significantly since the Fed's comments, up at about 0.5% right now. 105.31 is the last tick. What have you seen this week with the dollar index?
Well, you know, it's been positively correlated to 10-year Treasury yields, of course, and the dollar index went decisively below its 200-day moving average yesterday and support around 105. But if it comes right back above, that breakdown essentially will be left unconfirmed, and that's what could be happening today. So we'll be watching that 105 level very closely for the dollar index on a closing basis. Below 105, the support's around 103, so it would be a pretty notable decline that we could see on the back of that breakdown. So it's a very key level that's in play here, as with 3.5% for 10-year Treasury yields.
Katie, we're out of time. Maybe 10 seconds on Bitcoin, what we've seen. We were at 17,000. Not sure where it is right now. Somebody put a chart up?
So there, too, we have indecisiveness. It's really back into a consolidation phase. This follows a big breakdown below that 18,300 level. So I think risk is heightened there. And I'd be watching very closely the boundaries of that consolidation phase.
Got it.
A dip below it would be a breakdown.